Hello all, this is Akshara Menon, analyst at PMS Bazaar. Welcome you all for another round of a webinar on the topic, the secret sauce of quant investing. Before jumping on to the topic, let me give a brief about the AMC and the guest for the day, Mr. Sandeep Tyagi. ST Advisors Private Limited, established in 2008, post SEBI's approval for algorithm trading in India, specialized in quant-based investment management, advisory services, and execution. With over 14 years of experience, ST boasts a robust track record in Indian capital markets, serving as a SEBI-registered portfolio manager, service provider, and broker-dealer across major Indian exchanges. Managing assets exceeding 1,500 crores and trusted by over 8,000 clients, ST is a prominent player in listed securities and derivatives market. And about the guest of the day, Mr. Sandeep Tyagi, the chairman and managing director. He also BTech from IIT Delhi and MBA from Columbia Business School and is a CQF from London. He spearheads the firm's vision, cultivates a winning culture, and crafts profitable investment strategies. Previously CEO of Indexes, Tyagi's expertise spanned serving major financial services worldwide in areas such as investment optimization, target marketing, and risk management. He also positioned on multiple prestigious boards, earning accolades like a 40 under 40 for New Jersey and Distinguished Alumni Service Award from IIT Delhi. So over to you, sir. Before that, I would like to request a participant to put their questions in the Q&A box and not on the chat box, and not to ask any stock-specific questions. Thank you. Over to you.
Thank you. Thank you so much, Akshara. It's good to be here and to speak to the members of PMS Bazaar. I'm going to be talking about quant investing. That's the topic of the day, and I'll share some methods that we use. Some people have an image that it is a black box. It's a very mysterious thing, and even the name of the presentation today is the secret sauce in quant investing. Well, if you've seen Kung Fu Panda, I don't know if you've seen that movie. In that, the hero is looking for the secret, and eventually when they find the scroll and they open it up, they find there is no secret. And quant investing is somewhat similar. It is mysterious. A lot of people don't understand it and believe that it is something which is very arcane, very difficult, but there is no real secret in it. It's very systematic. It's actually very transparent. So I hope in this 1 hour, I'll be able to get you to understand how we do quant investing and what kind of returns and performance can you generate by doing that. So let's get started. I'll share my screen. You should be seeing a screen right now which says Secret Sauce in Quant Investing with ST's logo. Akshara already gave you a quick introduction, but to cover, we are a company operating since 2008, which is when SEBI actually allowed algorithmic investing. So we were one of the first companies to be built purely to do quant investment work. My background is in computer science and finance. I was educated at IIT and Columbia and have been doing analytical work for about 30 years for financial services institutions all over the world. We have over 100 people, and our core focus is building the technology. So we have actually built a platform that can store tick-by-tick data as well as long historical data going into decades. And we have the capability of processing over 10 million orders per day, storing all of that information so we can understand what's happening in the market. The team is very technically savvy. Most of the people have engineering kind of backgrounds. We are licensed not only in India as an investment manager, but also in Brazil, Mauritius, US, Dubai, Singapore. We focus building on systematic database strategies, which we'll talk about. Now, what are the questions that I'm trying to address today? First is this a right time to invest in equities? I know a lot of people have this question whenever we do these webinars, and they talk about how to think about investments and what is the right time to invest in the market. Second is, how can I create an edge in my investment? And what type of methods can be used? What's the right type of approach to use in investment? I'll try to address these two questions today. So the two takeaways from our side would be, first, focus on time in market, not market timing. So if you try to time the market instead of time in market, your returns are going to be much less, because it's been generally proven very, very difficult and nearly impossible to predict whether the market, which is already very high, will continue to go up, or a market that has corrected will reverse and start having a V-shaped recovery immediately. So timing the market is a very difficult job. And frankly, we have done many, many models on it, and we can usually only stick to an allocation instead of saying now is a good time to increase allocation, now is a good time to decrease allocation. Second thing we'll talk about is, think about where edge can be created and what is a sustainable edge that you can create. What is a better investment strategy of all the things that are available in front of you? So let's first focus on time in market, not market timing. When we look at our returns, there are 4 charts on here. If I didn't put the label, it will be difficult to figure out what's going on in the first 2 on the left and the top 2, because there is really no trend. Sometimes it's up, sometimes it's down. But when you look at the last chart, which is at the bottom right-hand side, the trend is quite visible. You know, over time, the markets go up. But on a day-to-day basis, sometimes they are up, sometimes they are down. Even on month-on-month basis, sometimes they are up, sometimes they are down. Now, on a year-on-year basis, mostly they are up, but still you can't be sure on which year they're going to be up, and some years they will be down significantly. But when you get to a decade, it's a different story. Now, most of us, our investment focus is what to do today, tomorrow, next week. But in reality, we are really investing for 30 or 40 years. You start working and earning and saving in your 20s. You keep working till you are maybe 60s. So at least for 40 years, you're going to have excess savings which you are trying to invest. So your vision for savings and investments needs to be multi-decade rather than days or weeks or even years. Now, when I look at this data in a slightly different way, this is what it shows like. When you look at days, roughly 54% chance that a day is going to be positive. So some days are negative, some days are positive. When you're in bull market, maybe 70% of the days are positive. When you're in a bear market, maybe it's the reverse. But on average, over long periods of time, it's only a slight chance that a given day is going to turn out to be positive. 61% in a monthly return, 75% in a yearly return, and 98% in 5-year returns. So again, the first thing you've got to get clear in your head is, when you're evaluating how your strategy is working, the shorter duration you evaluate it on, the more the chances that you're going to be not sure whether something is working or not. When you look at it over a longer period of time, you will have a much better sense of what is the real edge that you are creating for yourself in the market. Now, we will maybe spend a minute or two on where we are with the markets currently. So we like to look at this data, which is, what is the price to earning? Now, everybody knows what the PE ratio is. Just to recap, it measures how expensive is the market relative to what kind of profits is the market creating through its underlying economic activity. So if a company is making 100 rupees per share of profit and it is priced at 1,000 rupees, then it has a PE of 10. That means it's priced 10 times the profit it's making. Now, when we say a market is expensive or cheap, what do we mean? We mean if the PE is very high, then the market is expensive. For the amount of profit that the companies are generating, the price is very high. So we create a metric which looks at where is the PE relative to last 3 years of price to earnings ratio in the market. For Nifty, we are at about 42.5 percentile. That means more than half the time in the last 3 years, the PE of the market was higher than where we are today. So means it's expensive, but about average or less than average. Mid cap, it's a different story. We are at about 60%, and small cap, it's still different story. We are at about 80%. That means we are close to getting peaked out in terms of our returns from small caps. Now, this goes in cycles. In 2022, small caps didn't do very well. Large caps were doing very well. So their PE was probably already going high, but now it's been the reversal, and Nifty small caps are getting close to about 80 percentile of their performance. Now, what impact does it have? This is another chart, and let me explain what's going on here. The blue line is what is the relative position of price to earnings right now. So as I said, about 42% right now. 2-3 months ago, it was down to 4-5 percentile, meaning it was quite low relative to last 3 years. Whenever it is low, like here, the returns in the next 3 years are very high. So when it was low, the next 3-year returns expected from this point are high. And we have seen some of it already. We have already seen quite a bit of good performance in last 4, 5, 6 months. Now it's coming to median points, and in median points, you're going to get medium returns. So we are probably not undervalued anymore, but we are still in a reasonable shape and not overvalued. Same thing when we look at Nifty mid cap. Again, when you're low, the next 3-year returns are going to be very high. We are not very low. We were low in about May time period, and now we are more closer to median or just above median. Same thing with small cap. Here the colors are flipped, unfortunately, but the red line is the price to earning ratio over last 3 years. The blue line is next 3-year returns. Same story. When the ratio is low, the next 3-year returns are going to be high. And now we are kind of getting close to a high point. And when the returns, when the ratio is high, the returns tend to be a little bit lower. So I hope that gives you some understanding of where we are in the market and what is the benefit of timing the market versus staying put and staying in the market. There are lots of other data that we can show you. For example, if you miss the upswing in the market just for a few days in a year, then your returns go dramatically lower. So people who are waiting to see I invest when the markets correct or when the markets are down, well, how will you decide? Let's say it's down 3%. Do you invest? Is it down 7%? Do you invest? And most of the time what happens is you're too late making that call. And I know a lot of people who since 2020 COVID time have been thinking they're going to get back into the market because everybody was panicked at that time. And have still not gotten in, and the market is at a much higher spot right now. Now, second key takeaway that we want to focus on is knowing where to create edge. Let's talk about this. First, the market is like that proverbial elephant. You must have heard the story. आप लोगों ने ये हाथी वाली कहानी तो जरूर सुनी होगी. That depending on how you look at the market, it looks different. To some, it looks like a spear. To some, it looks like a snake. To some, it looks like a wall or a fan. Same thing in the market. When you look at stocks and sectors, everybody has a different view. So what do? We have to create a balanced approach. What does balance mean here? I know a lot of people in India today believe in momentum. There are lots of stocks, funds, PMSs, and other experts who vouch that momentum investment is a great way to invest. Now let's look at how momentum did over the last few years or last about 15 years. The yellow or mustard color box represents momentum. It is good. So for many, many years, it's been the second best performing factor. But it's also been the worst performing factor in 2009. It didn't do well in 2022. So some of you who are investing in momentum funds would probably have realized that last year was not a good year for momentum investments. Now, in aggregate, it does produce returns, but not always. What produce returns always? Well, the answer is there is no pattern. Sometimes it's value stocks, the blue box, sometimes that's on top. Sometimes it's momentum stocks, sometimes it's quality stocks. So there is a mixture going on all the time in terms of what is going to perform well. Same thing with sectors. So some people believe, that IT is going to do very well, or consumer discretionary is going to do very well. Bharat story and the growth of consumption in India will carry the day. Again, the same story plays out here. There is no pattern in these colors. If you look at the chart year by year, sometimes one industry is doing very well. See, for example, in last 2 years, utilities and industrials have done very well. And allocations into those two sectors have outperformed the whole market. Whereas IT has not done very well in last year. But IT normally does well because it's been a growth industry. So again, if you're going to be focused on a given factor or a given sector, it's very likely that you are going to miss many years of good performance. The last way in which people think about markets is market cap segments. So what is it that if you focused on small caps only or mid caps only, would you do very well compared to large cap? Well, let's look at that data. Here is the market cap indices performance trend. If you look at, we have color coded it. The green means this was the highest performing segment between Nifty 50, Nifty mid cap 50 and Nifty small cap 250. So yes, there is more green in small caps. So most of the time, small caps outperform, but sometimes they underperform significantly as well, like they did in 2008, like they did in 2011, and like they did in 2018 and 2022. So sometimes you are going to get that correction, and overall, the risk will be higher if you're investing in small cap. Sometimes Nifty 100 or large caps do very well, like they did in 2022 when the markets were really rewarding the large caps of the country. Now, what are the key insights from all of this data that I have shared with you? Well, it is very challenging to figure out a single factor, which means type of investing, momentum, value, quality, or sector, saying I'm going to invest in consumer discretionary or in IT stocks or financial services, or even market cap segments that will work in every year, in every scenario. It just doesn't happen. So what is the way to create an edge for yourself in the market? Well, our approach at Estee is to create what we call a balanced portfolio. So we look at factors, momentum, low volatility, growth, value. We look at market cap and we look at sectors. And we combine all of this information to create a balanced portfolio. So we are looking at, a lot of different pieces of information. And I'll take you through what kind of information we are looking at in just a second. And when we combine all of that, into a portfolio, then we get that balanced output. Okay, so this we already covered. Let's look at the approach, what it has produced for our long alpha product that we run as a PMS portfolio. So first of all, this long alpha is focused on the universe of top 500 companies in the country. So we take the top 500 companies listed on a BSE, which is similar to NSE. We build a quant model evaluating over 130 attributes of each of these companies, and then see which attribute is able to distinguish whether a company is going to do well or not well. So when we have that individual rating across 130 plus parameters, then we say which ones are able to predict performance well, given what is the macro environment right now, given what has been happening in the market right now. And then we create a portfolio by combining some of those 130 factors which have been performing well and are supposed to perform well in the given economic environment. We think by doing this, we are able to create a portfolio which has an expected return of 5% better than Nifty. And we'll show you some data historically that has been true. Again, caveat, these are market investment, not necessarily that will continue to be true, but that's what we have been able to deliver historically. The expected drawdown is about 20%. Again, markets can correct a lot more than that. But in the period that we have tested this, which is since 2009, and in the live market, the drawdown has been much less. That has been the maximum loss we have seen. Now, let's look at the actual performance. So since 2019, when this product went live, the S&P 500 returns are shown by the red line. Our long alpha returns are shown by the dark blue line. So as you can see, we have performed very well over this period. When we look at our back-tested performance, this is what we had seen. We had seen that our annualized return would have been 33-34% against Nifty's return of about 13%. So about 20% outperformance. Now, this is the actual return. So since we have launched, our gross return has been about 30%, almost exactly in line with what our backtest was. And the excess return over this period, active return, has been about 21%. Again, almost exactly similar to what we had in our backtest. So in this period, doing a backtest over 12, 13 years gave us some output over this 3 years, 4 years period, which is quite similar to the backtest. But there is a range. There can always be underperformance to what we expect and overperformance. But this is the expectation that we have for ourselves, which means that our Sharpe ratio for those of you who don't know, is the ratio of your return to your risk is about 1.35, which is pretty good, which means we are able to generate more return than the risk we are taking as a ratio. For an index, this ratio tends to be about half. That means the markets produce about half the return of the risk that there is there in the inherent market. This is what the edge is. Edge means, can you generate relatively more return compared to the risk you are taking? I know one of the questions was already in the chat, and that was asking, how did we do during the downturn in 2020? So if you can see, in February and March, we lost about 12%. March was about 9.9%. The market was down more than 20% during this period, or 25, 26%, if I remember correctly. So we did quite well. And then we recovered very quickly in April, June, July, as the markets recovered. So this is what I mean by staying in the market, staying invested. In long alpha, in that year, we produce a 45% return against the BSE return of 18%. So very significant outperformance. So coming back to the building blocks, giving you a little bit more sense of what kind of building blocks we have. We build dynamic factors. These are all the factors that go into quant investing. If you read the material on internet or buy a textbook on quant investing, you will see things like price to earning, momentum, 6-month momentum, volatility, debt ratios, cash flow ratios. All of those things are called factors, and we have dozens, if not hundreds of them that we build together. Then we look at index information. What is in the index? Why do we look at this? Because India is driven by foreign investment flows, and a lot of the foreign investment flows, and now increasingly even Indian investment flows, comes simply in the index investment. That means a stock that's in the index gets lot more demand just by being in the index. So we calculate all of that, and we also look at what companies may be going out of an index and coming into the index. Then we look at institutional holding data. We look at what are mutual funds buying, what percentage of a stock is held by different funds and foreign investors, and what is the change in that holding. That gives us some indication of what is the market reduce it. And finally, some technical information. This is looking at the actual what's happening in the market. What is the buyers and sellers pressure? Is there what's happening in the option market? Is there more activity on the put option versus call options? All these technical information also gets factored in. All in all, about 130 of these factors are looked at. And as I mentioned, then we combine them by looking at what are the macroeconomic factors. We look at about 18 macroeconomic factors like inflation, interest rates in the country, price of gold, price of energy. All of these things together give us a macro regime, and we look at what has worked historically in what type of regime, and also what has worked recently. Putting together, we create a portfolio and we concentrate it. So instead of having position in all 500 stocks, we carry positions in only about 70 stocks. We also run a concentrated portfolio in our RIA platform called Gullak, where we only take position in about 20 to 30 stocks. So the last stage is, of all the scores, create a portfolio that's diversified, that's concentrated, and we are able to implement it well. So that's a little bit on our methodology on how we create these models. This is the month-by-month data, which I have already covered. This is another product that we run, which is called 𝐼𝐴LPHA. This is another approach to quant investing. This has been running since 2009. As you see, it has never lost money in any month, and certainly not lost money in any year. This is an arbitrage product. So what it is trying to do is find mispricings in the market between index and its components. And whenever it finds a mispricing, it buys the cheaper thing and sells the more expensive thing, which means whenever we trade, we always make money. It's sometimes we don't get that much opportunity, so we make less money. Sometimes we get a lot of opportunity, we make a lot of money, but we never lose money. That's the returns that we have been able to generate. This year is looking pretty good. We are already at 10% up to October, and November also was reasonable. So that's another PMS product that we run called 𝐼𝐴LPHA. Now, when we compare our products, this is the comparison of our 𝐼𝐴LPHA return against all the arbitrage funds out there. Over 1 year, we've done about 9%, 6 months, 5%, versus about 3% for most of the arbitrage funds. So our performance is pretty solid in the world of arbitrage. Similarly, we have, we can share with you the returns on our long alpha products. It has been a consistent outperformance to index of somewhere between 8 to 25% over the last 3-4 years that we have been live against the market, and certainly against many of the established existing funds. So that's a little bit about the products and how we create. As I promised, I would speak for 30 minutes, and I'm happy to answer questions. We are available on social media, so please feel free to follow or connect with me on LinkedIn. This is my profile, IN Estee Tyagi, or Twitter, or you can follow Estee as well on LinkedIn and on our website. So we look forward to having interaction, and if you have questions beyond what we are able to answer today, we would be happy to answer them online as well. I'm going to now turn over to Akshara to ask any questions that have come in, and happy to address.
Yes, sir. Thank you. Thank you for the one detailed explanation on long alpha and 𝐼𝐴LPHA as well. And of course, as I told you, even before the webinar could start, the questions are pouring in. And one of the questions, you just took it while making up the PPT. And let me give the importance of the question which came even before the webinar. The name is 𝐿ogesh_Kumar. Why should one invest in quant-based fund when it is fairly new and different from bottom-up approach?
Yeah, that's true. Look, I mean, new doesn't mean that it is not understandable. New doesn't mean that it is not going to be valuable for investment. I think the question you should ask is, how is it performing? Is it able to do well in different circumstances? It's able to produce returns for you, and does it make sense? I think the key in investment, like in most things in life, is it should make sense, common sense. I just explained to you how do we go about investments. In fundamental investment, frankly, it's more mysterious. You don't know what's going on in the head of the portfolio manager. You know, if the portfolio manager has a fight with their spouse and they are not in a good mood, they may not pay attention to a particular stock information that's coming in that day. If they don't like the management for whatever reason, maybe when they went to meet them, they were not treated properly or were not offered proper tea and coffee. Now they suddenly have a bad impression about the management. So a lot of biases can come up in fundamental investment. Now, a lot of good things can come up as well, especially if there is no information about how the company is going to do in their current data. Let's say a company just created a new drug which will cure cancer. Nothing in the quant data will identify that company as a great company. Except when that company stock going up, we will start seeing momentum in the stock. When their first quarterly earnings come up and they have made a lot of profit, we will start seeing value in that company. But when they have just created something new, which is not there in the data, a quant model will not know. A fundamental analyst can figure that out. So they are good for identifying things which are totally new. But most of the investing is not like that. Most of the investing is systematically finding what is a good value, what's not a good value. And for that, quant works very well. So even though it is new in India, quant investing has been going on for decades all over the world. And there are well-established methods in how you create it. Textbooks have been written. People have been doing this research for at least 60 years. Fama and French wrote their first quant-based model papers in late 60s. So it's 65 years that this research has been going on.
Okay, when you say that even quant has its own risk, so what is the quantitative risk management models or techniques you utilized to access to mitigate this portfolio risk, sir?
Yes, so we measure our risk both in terms of empirically how much risk we are going to be taking. We measure our risk in terms of factor exposure. So for example, we will measure how much exposure do we have to small caps, mid caps, large cap, how much exposure do we have to each sector, how much exposure do we have to each factor. Are we only investing as a momentum investor? Because if you're only doing those simple things, then frankly, our investors can replicate that very easily by buying an Nifty has a momentum index. So all you need to do is look up that momentum index and see what stocks they're investing in, and you can create that momentum fund yourself. The value is really in creating this whole process of a balanced portfolio, which is combining all these factors. So we measure our risk in terms of all these exposures. We want to make sure that we are not just doing one thing. We also measure our risk in terms of historical variability. How much did we underperform or overperform the index? How much does the index itself have a drawdown or risk in it? And those are the ratios and metrics that we showed you, which is what is the variability or volatility that is measured as standard deviation, and what is the ratio of return to risk that we have, which is called Sharpe ratio or information ratio.
So, what measures do you take to ensure the liquidity in this portfolio then?
Our portfolios are very liquid. We provide access to long alpha portfolio at any time. So you could come in or out of the portfolio anytime, and you could liquidate the portfolio as well. The 𝐼-alpha portfolio has monthly liquidity, which is because we typically invest in monthly futures. So if somebody were to exit during the month, it is possible they may have a negative return because the futures spreads converge and diverge, but they forcibly converge at the end of the month. So that's why in 𝐼-alpha, we don't allow you to take out money between month. We allow that at the end of every month. In long alpha, that's not a problem. You can come in and out as you would like.
Yes, so then what is the exit strategy that is followed in long alpha fund? If you could have, we could share with us an example of sector or something.
Absolutely. So the quant model that I showed and explained to you, that is used to rebalance the portfolio. Now, depending on the type of strategy, we may be rebalancing it every day, or we may be rebalancing it once a week or once a month, and sometimes some part of it is even once a year. Now, when the rebalance happens, a new model portfolio is created. So we know this is the model portfolio that is appropriate to hold if you were to go into the market today. Now, you are already in a portfolio. So when you're already in a portfolio and a new model portfolio has been created, there is some cost involved in going from the old portfolio to the new portfolio. Depending on the size of investment you have done, if somebody is investing 10,000 crores, their cost will be different than somebody who is doing a 1 lakh rupee investment. So depending on the size and the cost that we anticipate, we adjust how much we are going to change or churn in a given period. So that's how we kind of manage how the transition happens over a period of time and what liquidity we are able to provide in a fund on a every rebalance period. But our portfolio in long alpha is rebalanced once a month right now. In 𝐼-alpha, it's continuously traded. So every day we trade about 1% of overall market's volume is actually done by 𝐼-alpha product. So 1% of Nifty's volume is something that we do ourselves.
Okay. But when you say that ST use the model portfolio, for stock selection, quantitative aspects as well as qualitative aspects are very important. So what is the factor that you, ST, would consider to balance both quantitative and qualitative information while investing on stock? Quantitative, you have already explained. So something on qualitative side.
Yeah, we don't do any qualitative overlays. There are lots of qualitative information. For example, we do have analyst recommendations. Analysts come up with their recommendations, whether it's a buy stock or a sell stock. That information is available in quantitative form. So we know what rating they are giving them. So we only consume information that can be converted into quantitative form. We even look at social media posts, which is very qualitative, but we convert it into quantitative information. So we will measure things like how many favorable tweets did a company receive? How many unfavorable tweets did a company receive? That gives us some market sentiment. What is the market sentiment about the company? But we have converted a qualitative piece of information into a quantitative piece of information. So for us, we are not depending on an analyst or a portfolio manager to interpret and say this is good or bad. We are making it into a mathematical quantitative metric that we can systematically say if it is at this level, it's good. If it is at another level, that's not good, and make it a continuous systematic assessment.
So going back to the question asked by the audience. So the next question, when will quant-based approach underperform, and what percentage of asset one should consider investing in quant-based funds?
Yeah, I think quant funds depend on what type of factors and model construction they're using. It depends on so if a quant fund is, an approach which says I'm going to use systematic investments. So you could be a systematic investor using momentum. If you are a systematic investor using momentum in small cap, which a lot of the funds are, because they produce eye-popping returns when the markets are in bull phase, because you obviously pick the best performing companies and they go up a lot. But this can be done both by quant funds and by fundamental people. They can simply be focusing on this attribute of the market. So they will underperform whenever the markets correct. Whenever the markets go slow or go down, they will significantly underperform. We perform balanced portfolios. So we are not just momentum investors, we are not just value investors, we are not just growth investors. So we would underperform when there is something dislocation in the market happening. Market is not going up or down too much, but fundamental things are changing. You know, let's say interest rates just went up dramatically because of the way the world economy was or the inflation was. Now the market needs to adjust. In that period, till the patterns emerge, our performance would be somewhat subdued. But once the patterns reestablish themselves and say, okay, this is what's happening in the market, then our models will start doing very well.
The other question from
But it's very hard to know that this is a period where the regime is changing. This is all, as they say, analysis with hindsight benefit. So when it underperforms, we can go find a reason on why it underperformed. But I can't tell you today if next month it will underperform or overperform.
So the next question from the end was that based on 3-year rolling return, if we could invest now at time high, at all-time high, what is the expected return based on your model if you deploy as 5 to 10 lakh STP or a 1 block 100% investment? Lastly, do you get into cash stocks?
Do we get into cash? What?
Cash, into all cash.
No. So we do not do asset allocation as part of Long Alpha. Long Alpha is 100% equity exposure. So we are always 100% invested in equities. Now, we do advise people to do proper asset allocation, which means you need to decide how much of your money is in cash, how much of your money is in equities, how much of your money is in fixed income. And we have products in our RIA portfolio, which are called Gullak Gears, where we do provide that service. So we will then balance for you how much of it is in equities, how much of it is in fixed income. But Long Alpha is 100% equity product. It always is invested in equities, is 100% in there. It does not have an opinion. I mean, I just told you in the beginning of this that I don't have the ability to tell you when to time the market. So I cannot also then tell you when to be in cash or not. I would say, depending on your risk, you should set the right asset allocation for yourself and stick to it.
So then one next common question asked by 2 or more is that, so how much returns can one expect in next 3 years? Or somewhere like next 5-10 years, any of the period?
Yeah, I would say the answer should be closer to 10 years. If I look at where India GDP growth expectations are, I look at the patterns, last 10, 15 years, the average return in the Indian market has been about 16, 17%. I think long-term equity markets returns tend to be about 12, 13%. My answer would be for a country like India, which seems to be performing very well on macroeconomic level and economic growth level. Our GDP in real terms seems to be growing at 6, 7%. I think the latest print was over 7%. When the economy is growing at 6, 7%, the markets are going to grow at maybe double that rate. So you will end up getting about 14, 15% return. But the right expectations over long periods of equity investment are somewhere between 12 to 15%.
Okay, so when you compare Long Alpha with 𝐼-alpha, so what kind of investors would you prefer to go for Long Alpha or 𝐼-alpha?
𝐼-alpha is a replacement for low risk, moderate return, fixed income strategies. It hasn't lost money. It can lose money, but hasn't lost money. And it's more like whatever you would get on FD plus a little bit more. So it should be part of your fixed income allocation, whatever your asset allocation is in fixed income. From there, you can invest in 𝐼-alpha. Long Alpha is your equity allocation. It's your risk-taking part of the portfolio. So whatever is your allocation to risk-taking part of the portfolio, from there you can take investments in long alpha. For most young people, that number should be either 100% in equities, so no need to put in I alpha, or maybe 80% in equities and 20% in something like I alpha. Because you are earning, you have enough savings, and you are not consuming money from your savings. So your goal should be to maximize the growth you can get, which you will only get by putting money in equity markets. Now, for a retiree or somebody who's 70 years of age, they have all the savings, they are not working anymore. They need to be, and then it depends on how much money they have relative to what their expenditure is. For a person who has just enough money for living on their savings, they should not invest in stock markets too much. Maybe they should be 20% in stock markets, 80% in fixed income like I alpha. So it depends on what is your ability to take risk, what life stage you are at.
The next question from Nawat Singh was that, have you had an opportunity to experiment the options trading, and what are your thoughts on it?
Options in India have been growing dramatically. They have, I think, tripled in last couple of years in terms of the volume. Options are very powerful instruments. They provide very leveraged way of taking a bet, which means if you trade well, you can make a lot of money, but you can also lose a lot of money. We do trade in options in our proprietary trading book and in some of our international funds. In India, PMS does not allow levered exposures. So we don't have an options product for our PMS investors. And SEBI has actually been very concerned about this. Earlier this year, they came out with an analysis where they said 90% of the investors who are trading in FNO are losing money. So I would urge you to have a lot of caution in what you're doing. There are some ways like covered call writing and other strategies which can help you improve the returns of your portfolio. But be very careful. It looks very tempting, but like anything that's very powerful, it's also very dangerous.
And the next question from Sabri is that, can you please tell a book for a quant investing?
So for quant investing, there is a famous textbook by Kahn and Greenwald. Also, you should look up, pharma and French research. If you just Google, you'll find tons of material. I mean, every year there are thousands and thousands of articles and books that are published on quant investing. So, but Pharma French, Greenwald and Kahn, K-A-H-N, I think are good authors and experts in the area of quant investing.
And the second thing was from Sriram. What is the recommendation of duration for your I alpha investment?
I alpha is a monthly liquidity product, so you can invest for anything more than a month. We recommend that you invest with maybe a year's mindset. The reason for that is that typically if you invest for a 1 year, the interest rate that you're going to get on your investment, we do invest your money in a fixed deposit, ends up being a little bit better because we can invest in 1 year FDs rather than shorter duration FDs. So you can do it anything from 1 month to more than a year. The returns will be better if you are able to invest for a year or more.
So for long alpha, what is the duration that investors should stay ideal?
There is no lockup. You can leave after 1 month.
For long alpha as well. Yeah. Long, yeah. Okay.
We don't have any lockups in any product.
No, like not lockup. It's more like
it's not recommended that you leave after 1 month in long alpha. Long alpha, as I showed you the data, for example, if you evaluated us on a day-to-day basis, 54% of the time, maybe we are performing well, 46% of the time, maybe we are not performing well. So you may get very confused. Is this a good fund or not a good fund? If you look at it on an annual or multi-year basis, I think we will continue to perform very well on those bases. So my recommendation for long alpha investing, not just with us, but if you are investing in any mutual fund, any type of investment, do your research, find the right partner that you want to trust, and give them maybe 2-3 years to perform, because they may go through a 1 year period when they're underperforming the market. And if you're going to become impatient, it's very likely that you will go in. Most of the times, this is what's called performance chasing. You go into the fund which has done the best. Well, it turns out the next year they have not done as well. And then in the next year, they may do very well. So you are always investing in the one which did well, but did not do well next year when you invested. Now, that's not a mystery, because you're always trying to do the highest, you end up doing less than average. It's much better to look at longer term returns, say this is a good investment company, give them the trust that you want to give them 2-3 years to prove how they are doing. That is a much better approach than evaluating it on a month-by-month basis or even on a 1 year basis. It has to be a little bit longer than a year to evaluate something like long alpha. Arbitrage funds you can evaluate even in 3-4 months. If they're not done well for 4-5 months, that's probably a good indication that there's something is not working, but not in long alpha. Long alpha needs more time.
With that, I just have a question. So when you say the quant-based fund are not much human-driven, so is there any machine learning or AI techniques integrated in this long alpha fund?
Akshay, I'm sorry, I didn't understand the question. Can you say again? Technique for what?
Like AI techniques, just incorporated in
AI techniques, yes.
Yeah. So what are
Yeah, so we use deep analytics and learnings in all our products. That's what our core is. There is deep analytics that can be used in identifying and estimating what is the return going to be for a particular factor. That's where we use analytics. Now, how we combine that, how we create a portfolio that's balanced, diversified, there more design work comes in, because there are just too many variables to put it just in a machine learning algorithm. See, we have to understand, where is machine learning algorithm work best? They work best when the problems are relatively well defined. So let's say I'm trying to identify, is this a picture of a chair or a horse? Very well defined problem. Machine learning will do very well, because I can give it millions and millions of pictures and I can tell them this is a cat, this is a horse, and I can, or a chair and a horse, and I can easily identify it. But in creating portfolios, India has become a different market in last 15 years. How can I train a model of how to invest in stock markets where there are only 500 companies which are investable generally, and there's only 10-15 years of data? You can't do everything through AI. We do as much as we can in terms of identifying factors, but then you still need to put a systematic approach to it, which is not pure ML. It is analytical, but it's not machine learning.
Okay. So once in every decade, we see events like we saw in 2020, which is COVID, or 2008 crisis, when market carried by 30% and can see a V-shaped recovery in the markets. In such periods, what is perceived a quant-based strategy underperform, because if one keeps a convection like a few long-term investors, so like we see that they make a lot of money. So how does this quant react to it?
Who makes a lot of money?
Long-term investors. They make a lot of money.
Yeah.
Like,
So
yeah.
see, long-term investors and quant investors share one thing, certainly in our approach. We are not saying you should go away from the market if something bad has happened suddenly. That's not our approach at all. We stay invested 100%. So in that approach, we are long-term investors. Now, we may change our view on what to hold depending on how the markets have behaved. And actually, in those periods, we perform very well. As I showed you month by month return, April return for us in 2020 was very high. And the reason for that is, when there is that kind of a dislocation in the market, people are becoming completely fearful. And when people are becoming very fearful or very greedy, that's when a systematic approach actually performs very well, because we are not getting greedy and we are not getting fearful. We are simply taking what are the averages, what are the statistical inference you can draw over long periods of time, and just stick with that. So we are not worried that the market is down 30%. We are not overexcited that the market is up 30%. We are simply using the same rules in both situations.
Okay. So how reliable is quant relative model portfolio in a capturing market trends or shifts, sir?
It's very, very reliable in capturing all the trends that are repeating. It's not reliable if something completely new is going to happen. The question you got to ask is, are you able to, or anybody is able to predict what is the new thing that's going to happen? If you have an expert like that, which we haven't found, then you should use it. We believe that history repeats itself, markets behave the same way, good companies continue to outperform, the factors work the same way time after time. So we try to find the patterns that are repeating. So that's, I guess, the answer to the question on, I think this is in a lot of people's mind, that how do you handle, completely new information? Well, nobody knows how to handle that. You wait for it to become known information, then you handle it.
Yes, that's true. So the next question from Deepesh was that, can one have complete portfolio of quant and totally ignore growth, value, and fundamental investing? Or quant will be one part of the basket and not a whole basket if the performance is so predictable or confident?
Yeah. So quant, momentum, and value are not they cannot be compared. That's not the right comparison. Yeah, quant and fundamental can be compared. Momentum, value, growth, volatility are all factors. So quants use them, fundamental investors use them. You should not rely on only one, as I showed you in detail. If you rely on only one, you are not going to have consistent performance. So you've got to use all of them, whether you are a fundamental investor or a quant investor. Now, when it comes to how much of your allocation should be to a quant investor versus a fundamental investor, I think that's not the right way to look at the question. I think you should look at 3 years, 5 years of performance, and you should say who is the most stable investors you can find, whether they are fundamental or quant. And then you should pick maybe 3 of them and give them money in 1/3, 1/3, 1/3 ratio. Say, okay, these are 3 good investors or funds. I don't have risk of an individual company. I'm trying to do few different things, and they're all doing good. Now, it may turn out that 1 is quant, 2 are fundamental, or it may turn out 2 are quant, 1 is fundamental, or may turn out all 3 are fundamental or quant, depending on how they are performing. That will depend on your research and what you value. But I don't think how they make stuff is important. What they are making and what results they are able to achieve is what you need to focus on. It's kind of like you go into a restaurant and say somebody is cooking on a gas or somebody is cooking on an electric oven. How does it matter? What do you care? You should care about, is the food good? Same thing. Whether they're investing using quant or they're investing using fundamental, you should care about, are their results producing what you want them to produce?
That's true. That's very true. So because of time constraint, I'm just taking the last few questions. Abhishek has 3 questions to ask you. The first question will be, what will be the average and max holding period of a stock in a quant portfolio, and what will be the churn of the portfolio?
Yeah, Long Alpha does have a lot of churn. We do rebalance quite a bit. We trade about 30% buy and 30% sell. So about 60% of the AUM is traded every month, which is much higher than what a lot of mutual funds would do. Again, we do it right now because our size is relatively smaller than many of the large mutual funds. When we are trying to invest a much larger amount, we would bring this down. And we do offer for some of our investors a portfolio which has very low annual churn, down to about 5% a month. So the answer right now is the long alpha product, the way it is today constructed, churns about 60% of its trading volume every month.
Okay, the next question will be, does your investment philosophy not require meeting the management and taking advisory from sell side?
We do take advisory from sell side. We look at analyst recommendations. We don't meet the management. We don't do anything that a human has to interpret. We work with only quant information that can be consumed directly by a computer.
Next question.
So maybe one day computers can go meet the management, then we'll be doing that.
Because we have AI for that. So
absolutely. So we'll do AI Zoom calls, and based on that, we will create our models. That's how it will work.
So the last question for the day is like, does quant models follow margin of safety philosophy, and how much margin it looks for before investing?
Yes, that's factored in. So we always look at, what is the relative value of each stock. See, that may be another difference in fundamental investing and in quant investing. Quant investors are not coming up with an opinion that this stock in isolation of everything else will do very well. That's not what we are creating an opinion on. What we are creating an opinion on is, out of the 500 BSE stocks, what is the market return going to be? How do you generate market return? The way you generate market return is by investing in the market. If you invested in the index fund, you are going to get index returns. So what is the way to create an edge? Well, you've got to have some portfolio which is different than the index. So what is a quant investor doing? It's saying, of these 500 stocks, these 70 are better than the remaining 430. So we are creating a relative value. That's what we are focused on. Now, in margin of safety, what you're trying to do is, the price is this, the fundamental price is this. Is there a big enough gap between the fundamental price and relative price? And therefore, I'm going to invest. Now, a fundamental investor may reach the conclusion that all 500 stocks are undervalued, because everything's value in the market is much lower than what they are intrinsically worth. Quant will never get to that conclusion. Quant will get to the conclusion of, out of the 500, which is the most undervalued, and then hold those stocks rather than everything that is undervalued. That's not what we are trying to do.
Thank you, sir. Thank you for that. And that will come to the end of the session. Though there are a lot of questions to be taken, we will take it off. I'll be sending those questions to you. So
happy to do that.
Please,
I would again offer, please connect with us on LinkedIn, Twitter, Instagram. Put your questions. I look at them regularly, happy to answer. So feel free to ask all these questions there as well if they've not been answered.
Thank you for that, sir, and have a good day.